it's not a matter of yes or no, whether you're looking at a small scheme or a large scheme. Fiduciary management can work for any size scheme. Where the difference lies is fiduciary management in the way it has evolved in the Netherlands, this highly customized, bespoke governance solution that works for larger schemes, medium-sized schemes. As you go down towards the smaller end, I'm sure trustees would like to have such a customized model, but customized models with lots of interaction and engagement and exchange of information is by definition more expensive. And so there it becomes a trade-off between cost of having a more advisory model versus a more delegated model, which will tend to be more cheaper because you don't need to go back to the client every time you're making a decision. And so the smaller schemes automatically end up in a more delegated model. But I think it can be, the model as a concept can be made to work for any size scheme.
Yeah. And where do you think it's appropriate to have an in-house CIO or in-house capacity?
Well, what's
the cut-off point?
That's a build or buy decision. Like with anything in life, do I build my own car or do I buy one? I've come down on the side of buying a car. Clearly, there comes a size where you can start to hire some in-house resource, but I think a lot of pension schemes underestimate. So you hire a CIO, great, very good step as your scheme size increases. But how do you avoid? You've got operational risks to deal with. You've got continuity. If you just have one person in place, what happens when that person leaves? So there's nothing that says it's an either or. We see it with our larger schemes. They have an in-house team, and we slot in from below, providing in-depth expertise in emerging market debt and how to structure investments in that asset class. So I don't think there's a hard cutoff point, but I think for the larger schemes, I would encourage larger schemes in the UK, and then I'm referring to several schemes with several billion in assets or more, to actually look at a co-sourcing model where, yes, you want to have some of your own people managing the fiduciary manager and using the fiduciary manager's skill and expertise and purchasing power and whatever else to bring that to bear to benefit your own scheme.
Malcolm, where do you sit on the size issue?
I would basically agree with what Remco said. I think it is appropriate for all sizes. I think it's very appropriate for the smaller, medium-sized schemes because of, as we've said before, the skills that it can bring for a relatively good economic price. As you get larger schemes, so you have more resources you can bring to bear. But in a way, what those extra resources do in-house is really to bolster the skills of the trustee board. So if you have an in-house team or even an in-house team of one person, they're really, I think, working with the trustee board to look and challenge at what your fiduciary manager is doing. But nonetheless, that's what they're doing. They're helping the advisory and the decision making rather than the actual operation and management of the assets and liabilities. And so I think that's what happens. As you get larger, you have more options because you have more money to play around with, but it doesn't change, I don't think, the overall concept of what we're talking about here.
Do you think that, what about this issue of sort of, different, customized solutions versus more,
Yes.
single dancing solutions?
Yes, I think it to some extent it depends on the board and their views and where they're coming from, their history, and also the degree of expertise on the trustee board itself. I can see both working. For ourselves, we find that where we are working with a fiduciary manager, we take some of the decisions ourselves. So we take very much advice and often, usually act on that advice from our fiduciary manager. But the final decision and some of the investment issues is with the trustee board. And we feel very comfortable with it. But that assumes that you have a good degree of expertise on the trustee board. If you don't, then I think it's perfectly appropriate to leave the whole investment side to your fiduciary manager.
Yeah. Yeah.
But obviously there are certain things, and no doubt we'll come on to those, which you would look to the fiduciary manager to provide in order that you're comfortable with that kind of governance.
I think it's important to separate what you might call the two different aspects of fiduciary management. I've mentioned this before. This is the sort of the advisory side, which is aligned with the historical development of the UK pension sector coming out of the consultancy business, and the implementation asset management side. So naturally the advisory side is very labour intensive, human intensive, and is more difficult to offer what you might call customised responsive relationships and implementation to the smaller schemes. But when you get to the bigger schemes, you run into the problem that essentially the asset management side is a technology business, and that's very capital intensive and very expensive. And even for quite large schemes, the economies of scale don't start to pay off until you're really at quite large sizes. I don't think there's a conflict between having an in-house team and having a fiduciary manager, and Remco's highlighted that issue very well. That you can have the in-house team very much performing the kind of advisory, strategic investment role, but then having an asset manager that acts as the sort of the single point, as I've said before, the single point of implementation to make sure that the decisions that are made are enacted in a timely and efficient fashion, are monitored on a daily, weekly, monthly basis, and reported back to the in-house team. So the simple separation between small and large, I think, belies the actual separation, which is much about the advisory and the implementation side of the business. The what you might call the human and labour costs in terms of the advisory side, and the sort of the capital technology costs in terms of the implementation side.
I wouldn't disagree with, much that's been said. I quite like this co-sourcing model for the bigger schemes. I think I've heard it said that unless you are so huge, such that you can afford to buy in the very best people, and by so huge, we're talking double-digit billions and above that, not single-digit billions, so that you can afford, if you're going to do it yourself, you can have the very best in-house capability to do it all for you. Then you should consider a degree of delegation. And I suppose the small schemes probably understand that they aren't as good as they might be, and may well get to the point where they will move to a more fiduciary type model. It's the schemes that are sort of almost in the middle, the billion to low billions, who I think perhaps are not as self-aware of their limitations as they might be, and perhaps think they are big, but they're not really that big. They're certainly not big enough to benefit from the economies of scale that Remco referred to. They're certainly not big enough to hire the very best in terms of asset capability, trading capability, all those sort of things. So I suppose there's almost that grey area in the middle that actually I would challenge. When they think we're big, we don't need it, I'd say they should still think about it in some way, shape or form.
I think there's some interesting comments there. In my experience, even the very largest of UK schemes do need help, and they do tend to outsource. Even when they've got very, very good investment teams in-house, I think they recognise their own limitations, and they can actually get extra value from using specialists where it's relevant to do so, whether that be for manager selection or pieces of strategic work. So I think this sort of co-model that's been described is a very good one. From a provider perspective, it's all about scalability, and can we actually look to put in place solutions which are streamlined and scalable enough for the smaller schemes, which give them meaningful benefits. And I think that's about capturing the big decisions and getting the big decisions right, and adding real value in that way. Because even for the very small schemes, if we can look to actually pool what we're doing in terms of assets, manager appointments, and the sort of approach to some of the strategic elements, we can actually make real inroads and benefits for them in a cost-effective way.
Yeah. What about this sort of customisation? Where does customisation kick in, do you think?
Customisation rather kicks in terms of fee resistancy, I think, because it depends how much work the client wants and where they want to go in terms of customisation. But I think even when we're talking very small schemes, sort of single-digit millions, 8, 9, 10 million, that sort of size, you can put in place a relatively robust product that will deliver most of what they need. That sort of size scheme would not want to be bespoking because of the cost implications. But I think when you get into the hundreds of millions, then you can look to start to.
There has to be an element of bespoking for everyone because every scheme's liabilities are different, and so trustees are obliged to recognise that fact. But maybe the building blocks can be a bit more customised. The pooled funds or the multi-manager funds that they would use to implement.
Yeah, I think the process you can use is you're right, all the liabilities are different, but the process you can use to track the liabilities, to identify trigger points, can be applied consistently across different clients.
Yeah. What about for those mid-sized schemes that you were referring to earlier on? I mean, how much do they need customised solutions, or again, should they really be going for the more mass market?
They probably need a degree of customisation, I would say, or certainly in terms of persuading them that this is a way to go, I think they would think they needed that. Yeah. Whether they actually need as much customisation as they would demand. So it might be that you start off with a lot of that, but as they gain trust and faith and confidence in you as a fiduciary manager or your provider or whatever, it may be that they recognise that the big ticket wins that they're getting are about risk management and relative to the liabilities and a disciplined hedging framework and those sort of things, because they're the things that have blown schemes out of the water over the last decade, rather than manager problems or manager selection issues. So they might well, over time, as confidence builds in a decision that they've taken, begin to accept more customisation. So ironically, they might start out, I'm speculating here, they might start out feeling they need to be very bespoke, but as time passes, a good fiduciary manager might well be able to start closing down some of that specification as they go forward.
I mean, to put some real examples, that's exactly the experience we have with our clients. So we start out with a highly customized model with retaining all their existing managers, and then first doing a strategy review, and only once we've done the strategy review and the trustees are on board with the strategic ALM issues that need to be resolved, interest rate hedging, diversification of the growth portfolio, then we start to take it down to individual asset classes and ultimately individual managers. And I think a lot of trustee boards, once they've made the switch from looking at individual managers, i.e. starting at the bottom, which is what they're used to, and you've actually taken them through the strategic investment issue, and they're starting to think about their funding ratio and how interest rates affect it and de-risking and whatever else. Then by the time you get back down to, okay, so we need to have X% invested in US high yield, then a lot of trustee boards, in our clients then say, well, we'll give you a mandate for what type of US high yield managers we want, what the benchmark is and what constraints, but beyond that, off you go and you select the managers. Whereas at the start, they would be very keen to have the flexibility that we would retain their existing managers. So that it's fiduciary management is a journey, and I think that's why it's so important to have a provider that can offer that flexibility, because you may need lots of flexibility and customization at the start. Then there will be more delegation in certain areas, but perhaps at some point in the future, the trustees want to pull in the reins again and want to go to a less delegated model. So you need a really that's why ultimately fiduciary management cannot be a product.
And that's exactly been our experience as well. Clients quite often begin on what I would call an advisory model, and then over time, when they become comfortable with that advisory model, they begin to say, okay, well, can you not just take this problem away for us and just work on a delegation basis, please?
Yeah. How's your experience been, Malcolm, on the fiduciary management journey? I mean, has what you're doing changed in the last sort of five or so years since you started?
I don't think so.
No.
I think right from the beginning, we were in the hunt for a better solution than the one we had before. And we looked at lots of different offerings before we decided on the one that we actually took. And it has worked as we would wish, and so we are, satisfied clients. But I suppose the real thing behind this, it very much depends on the services, as has been said, services your fiduciary manager offers, the ability to be flexible, and the ability to be able to move from one governance model a bit towards another one. And I think that's where it comes. And then allied with that, you've got to have very much the transparency and the communication. It's the fundamental thing is having a partner that you can rely on and talk to, and if anything comes in the way of that, then you've got problems. But if the communication is good, then if the manager's got the flexibility, then you can change. You're not locked into something that has to be the same forever.